Aniriji, start the session.
Okay, okay, fine. Once Alfred E. Newman said, "Today it takes more brains and efforts to make out income tax forms and returns rather than it does to make the income." Good afternoon, everybody. And I, see Aniri Sheth, welcome you all in today's webinar on the topic applicability of tax audit and relevant amendments related to the assessment year 2023 and 24, and then followed by case studies to understand M&A in India. In a short while, we'll be starting with both the sessions, with the first session. But before we go ahead, I would like to apprise you about CP committee. As we all know, the role of chartered accountancy and chartered accountants has been evolving and allowing us to accept new opportunities, new responsibilities, upgrade our skills in order to suit the complex business environment around us. So today, the CP committee, with the same intention and motive, has also come up with this webinar on tax audit and mergers and acquisitions. The committee also believes that members of ICAI should look beyond traditional areas of practice and seek and explore new areas of business and professions. So, through various webinars, seminars, national conferences, and other materials which are being introduced by CP, they are doing so and are allowing us to learn and upskill ourselves. We are pleased to inform that ICAI is going to organize its first ever Global Professional Accountants Convention, which is shortly named as GLOPAC, on the theme Connecting the Globe, Creating Value. And it will be conducted in the month of November, dated 24 to 26 at Mahatma Mandir Convention Center, Gandhinagar. So it is a privilege for Gujarat as well to host this event on behalf of ICAI. GLOPAC is being celebrated as mega event to display the important role of our profession, that is accountancy. I'll be playing a short video which talks about this GLOPAC event as well as message from our president and vice president of ICAI. I'm about to share the video.
It gives me immense pleasure to announce that the Institute of Chartered Accountants of India has decided to organize its first ever Global Professional Accountants Convention, GLOPAC, on the theme Connecting the Globe, Creating Value, on November 24th to 26th, 2023 at the Mahatma Mandir, Gandhinagar in India. GLOPAC is being celebrated as a mega event to showcase the important role that the accountancy profession has been playing in the economic and social development of our country.
Globalization has made the world one village, and the services of chartered accountant are also available globally without any boundaries. The Institute of Chartered Accountants of India is also devoting significant efforts towards global networking. The convention shall be attended by more than 3,000 delegates from around 40 countries. I would like to extend a warm welcome to the fraternity on behalf of ICAI to attend and participate in the first ever GLOPAC
ICAI is geared up to welcome delegates from across the globe at the GLOPAC.
Yes, so as our institute has conducted many global events, I hope this one also becomes super successful and reaching out to as many chartered accountants and accountant professionals across the globe to participate in this mega conference. Let's move towards today's webinar. Today's webinar will be dealt in two sessions. So first session of 1 hour will be about tax audit and its intricacies and relevant amendments from learned faculty from Ahmedabad, CA Divyang Shah. And the second session will be taken over by CA Binoy Parikh from Mumbai on understanding M&A in India. Let me have this honor to introduce my own faculty from my college times, CA Divyang Shah, who is young, dynamic chartered accountant professional practicing in the field of advisory consultancy and litigations of income tax law and other allied laws since 2010. He has served as committee members to different committees from Ahmedabad branch of WIRC of ICAI from 2012 to till date. He has been a speaker and is still a speaker on different topics of income tax, conducted across India, where ICAI hosts expert faculty, and taken many other sessions on the said subject at Ahmedabad branch as well as another branches of ICAI. So, sir, it's a privilege again to listen to you, and being your student from my college days to introducing you is always a pleasure. Over to you, sir, and take us to the journey of tax audit.
Thank you. Thank you, Aneri, so much. Hope that I'm audible perfectly.
Yes, sir.
So thank you, Aneri, again for this such a warm introduction. And also need to appreciate the efforts taken by our president of the ICA and the vice president for conducting these online kind of sessions, wherein everyone can attend the sessions on a weekly basis and they can learn it. I think a learning is a journey. So if we understand that after completing CA, learn completed, that's not the way we should look into the things. And then after, would like to appreciate or rather recognize the efforts that are taken by the CA Purushottam Khandelwal, our CCM, and also the chairman of the CP committee, and also our CA Gyan Chandra Mishra, who is the vice chairman of the CP committee. So would like to take you to the topic. Before that, tax audit is the topic, wherein lots of people had a query that whether tax audit is applicable or not. So for that, we are going to take the half an hour or maybe approximately that time, that when tax audit is applicable, why there is a complication has been arisen that tax audit is applicable or not. That is because of the interplay between the section 44AB, which talks about the tax audit in the normal course of action, and because of the section 44AD, which talks about the presumptive taxation if you are declaring 6 or 8% and then after coming out of the provision. So before I may jump to the different conclusion or rather refer the PPTs, I would like to refer the provision first of all. So let's refer the provision of section 44AD. Section 44AD says if your turnover is below the 2 crore and if you're eligible assessee, meaning thereby either you are individual, HUF and partnership firm, but you are not the LLP. In that case, you are eligible assessee, your turnover should be below 2 crore. Your business income should not consisting of the commission or agency business or some different kind of deduction you should not claim. In that scenario, what option is given by 44AD? That of your turnover, you can declare the profit at the rate of 6% or 8%. Now, if your 6% is a basic rate, but if your receipts are not through a banking channel, then you need to disclose it at a 8%. These are two rates are available, but that is not the issue. Now, earlier, there was no restriction in 44 AD. Then once you have gone for 44 AD in subsequent assessment year, you cannot come out of the 44 AD. Meaning thereby, in the first year, I have declared a 6% as a profit of my turnover. But in the second year, I am not interested to declare 6% because my actual profit is less than 6%. So I'm not declaring 6%, rather I'm declaring a lesser than that. So earlier there was no problem, but since few years back, section 44 AD subsection 4 is introduced that I would like to share with you over the screen. Just a minute. So this is the basic subsection, talks about that you need to declare at the rate of a just. This is subsection 1, which says notwithstanding anything to the contrary contained in section 28 to 43C, in the case of an eligible assessee engaged in the eligible business, a sum equal to 8% of the total turnover or gross receipt of the assessee in the previous year on account of such business, or as the case may be, a sum higher than the aforesaid sum claimed to have been earned by the eligible assessee shall be deemed to be the profits and gains of the business, chargeable to tax under the head profits and gains of the business and profession. So of the turnover, either declare 8% of the turnover, or if you are claiming that you have earned the higher income, you can claim the higher income as well. But over here, word use are not whichever is higher. So you are not
Sir,
yes. Yes.
sorry, your voice was breaking and it was not perfectly audible. I guess we missed a few words.
Okay, done. I'll repeat the last one. Is that fine?
Yes, please. Yes,
Thank you.
yes, yes.
So what I'm saying that in the subsection 1 of the turnover, you need to declare the profit at the rate of 8%, or over here is the word, or as the case may be, a sum higher than the aforesaid sum claimed to have been earned by the eligible assessee. This is the word I'm referring. Over here in this section, nowhere it is mentioned that you need to declare whichever the higher is. That is not the wording. So in the second clause, I read in a way that if you know that you have earned the higher income, then you can declare the higher income. This is optional. We cannot put it compulsory, but still lots of confusion will be there, or near future there will be litigation on this part as well. But we are skipping to the next. Now we are going directly to subsection 4. Over here it is. If my voice is cracking anytime, let me know. Okay, done. So we are referring subsection 4. What is subsection 4 talks about? Where an eligible assessee declare profit for any previous year in accordance with the provision of this section. Meaning thereby in this section means they are declaring the profit at the rate of 8% or 6%. So let me say that year is assessment year 1819. And then after, and he declared profit for any of the 5 assessment year relevant to the previous year, succeeding such previous year, not in accordance with the provision of subsection 1. Meaning thereby, after that for 5 years, you have to be there in 44 AD. Meaning thereby, if assessment in 1819, I have gone for 44 AD, meaning thereby I declare the profit at the rate of 8% of turnover. Then for next 5 years, I have to declare the profit at the rate of section 4, at the rate of 8%. Let me say I have not done that. For example, in a 1920, I have declared the lesser profit by getting my books of accounts audited. I declare the only 5% of the turnover as actual profit. Then what will happen? He shall not be, over here he means the assessee, it could be she or it could be firm. He shall not be eligible to claim the benefit of this provision of this section for 5 years subsequent to assessment year relevant to the previous year in which the profit has not been declared in accordance with the provision of subsection 1. Meaning thereby, if in 1819 I have declared at the rate of 8%, meaning thereby I have gone for 44 AD. In 1920, I have not declared profit at the rate of 8%, rather lesser. then 8 or 6%. So after 1920, can I go for 44 AD? Answer is no. For 5 years, I cannot take the benefit again of section 44 AD. And my humble request to everyone, we have two topics. First is text audit application. So if anyone having any doubt would request to post your query in the chat box. After completion of this one topic, I'll take the query. Okay, done. So there is a second part that he shall not be. This is done. Now, what subsection 5 says? Notwithstanding anything contained in the foregoing provision of this section, an eligible assessee to whom the provision of subsection 4 are applicable. To whom subsection 4 will be applicable? That once you have gone for 44 AD and in the second year or in any of the 5 years after that, you have come out of the 44 AD. In that case, subsection 4 is applicable. Am I clear? So, into whom the provision of subsection 4 are applicable and whose total income exceeds the maximum amount which is not chargeable to income tax, meaning thereby his total income is more than 2.5 lakh if they are individual HUF. In that case, that individual HUF need to maintain the books of account and get that audited as well. That is what mentioned over here. Done? So this is the background. So now let's take the, I'm just sharing the another screen. Okay, now what 44 AB says? 44 AB says every person carrying on the business shall, if his total sales turnover gross receipts as the case may be in business exceeds 1 crore in any previous year. So if your business is exceeding 1 crore, then 44 AB audit is applicable. But we need to refer the proviso as well. Over here, proviso is given. Proviso says, provided that this section shall not apply to the person who declare profit and gain for the previous year in accordance with the provision of subsection 1 of section 44 AD and his total sales turnover gross receipt as the case may be in business does not exceed 2 crore. Meaning thereby, if you are declaring the profit under section 44 AD, then doesn't matter your turnover is more than 1 crore, still you are not required to get your accounts audited as per section 44 AB clause number A. Is that clear? Now, second thing, proviso is added. What is proviso says? I'm just giving a short brief. Proviso says if your turnover is more than 1 crore but less than 10 crore, in that case, your receipts and payment in cash should not more than 5%. So for example, my total receipt in the business is 1 crore. Out of that, the 96 lakh is through banking channel, but 4 lakh is through a cash mode. So in that case, my cash receipt is more than 5% of total receipts? No. So I'm fulfilling this condition. That is the first that total receipt in cash should not be more than 5%. Now, second is says that in the same way, even a payment should not be more than 5%. Meaning thereby a payment in cash should not be more than 5% of total payment. So let me take an example. During my business, total payment during the whole year was 2 crore, for example. Out of that, my payment in cash is only a 4 lakh, for example. And my total payment including cash is 2 crore. So my cash payment is only 2% of the total payment. In that case, whether my cash payment is restricted to 5% of the total payment, answer is yes. So second condition is also fulfilled. If that is a scenario, then in that case, the limit of 1 crore shall be substituted by the 10 crore. So meaning thereby up to 10 crore, I need not to get my accounts audited, though my turnover is more than 1 crore or 2 crore. Is that clear? Done? Now, moving to this proviso. Now, this one. This proviso is E clause. What we are referring section 44 AB. Every person who need to get account audited in that category A, in that first proviso has a clause number A and B. Then after there is a subclause B, clause number B of section 44 AB. then after clause C, then after clause D and clause E. Clause E is one of the situation wherein you need to get your accounts audited. So what does it say? Again, every person, now directly clause number E, carrying on the business shall, if the provision of subsection 4 of section 44 AD are applicable in his case and his income exceeds maximum amount which is not chargeable to income tax in any previous year. So if you are falling in 44 AD subsection 4, then you need to get your accounts audited. That is a requirement. Now, let's take a different scenario. Just a minute. Let me share my PPT now. So, done. So what will happen? Let's take a scenario that in assessment year 2017-18, a person has declared a profit as per section 4480 subsection 1, meaning thereby he declared the profit at the rate of 6 or 8%, whichever is applicable. And from assessment year 18-19 to 20-23. So how many years are there? 18, 19, 20, 21, 22. 5 years are completed. So from assessment year 18-19 to 22-23, person has not declared profit as per section 44 AD subsection 1. So in those years, audit could be applicable in those 5 years. But what about assessment year 23-24? So, and in this year, person has a turnover less than 1 crore and have a profit less than 6% of turnover. And they have decided to declare a profit less than 6% of turnover. Whether audit will be applicable, this is a question. So first of all, let's check the applicability of the audit from the perspective of section 4480 subsection 4. Subsection 4 says if once you have gone for 4480, that is 1718. Then after, if you have come out of the 4480, that is 1819. Then for 5 years, you cannot choose the benefit of the 4480. Shall we refer that section again? Just a minute. I need to jump for this part. So what subsection 4 says? Where an eligible assessee declare profit for any previous year in accordance with the provisions of this section and he declared profit for any of the 5 assessment year relevant to the previous year succeeding such previous year not in accordance with the provision of subsection 1. So whether they have declared in their example, whether they have declared under section 4480 for next 5 years, answer is no. He shall not be eligible to claim the benefit of the provision of this section for 5 years subsequent to the assessment year relevant to the previous year in which profit has not been declared in accordance with the provision of subsection 1. So what they say, for the year in which you have not declared as per 44 AD, that is 1819. After that, for 5 years you cannot go for 44 AD. Now let's refer the provision. Now in this case, don't refer the answers. I'm again moving for 1819 to 2023. In 1819, I have come out of the 44 AD. So for next 5 years, I cannot go for 44 AD. So up to 23-24 as well, you cannot opt for 44 AD. So in that case, yes, audit will be applicable. Again, I'm repeating, don't go by the answers. Done? So audit will be applicable as per the interpretation. If you had any query, please post the same in the chat box. After completion of this part, I'll take all the queries. And one more most IMP thing, if you refer the section 4480 subsection 4, they have drafted the provision in a very weird way. And that's why there is a lots of confusions are there. So lots of different interpretation could be possible. What I'm trying to explain to you is this: whenever there is a confusion from the point of view of the interpretation that audit is applicable or not, in that case, normally it should be suggested to client to go for the audit. Because by tomorrow, if you have seen, if you have taken one of the opinion that audit is not applicable, and assessing officer take the stand that audit is applicable, and because of that, they levy the penalty for not getting the accounts audited. In that case, you need to file the appeal, and cost of the appeal is normally quite higher than the professional fee for the tax audit itself. That's why I always suggest, if there is some confusion, please go for the audit, or at least suggest to a client that there's no clarity available perfectly, and that's why you should go for the audit. If then after, if a client take a call, then I don't want to go for audit though there is no clarity, then that risk is actually taken by the assessee, not by the professionals who are giving the advice. Is that clear? Let's take the another scenario. If a assessment year 17-18, a person had declared a profit as per section 4480 subsection 1, and from 18-19-2023, person has not declared profit as per section 4481, and in this year, person has a turnover less than 10 crore and they have a profit less than 6% of turnover. But let me assume his turnover is more than 2 crore. So in this case, whether audit under section 4480 subsection 4 is applicable, in that scenario, I would interpret that assessee has not come out of the 4480, rather it is because the turnover is higher than 2 crore. Let me take a scenario that in 18-19 itself, turnover was more than 2 crore, and that's why they come out of the 4480. And in this year as well, the turnover is more than 2 crore and less than 10 crore. In that scenario, what will be the interpretation? Let's refer subsection 4 again. Where an eligible assessee declared profit for any previous year in accordance with the provision of this section, yes, that is 17-18. And he declared profit for any of the 5 assessment years relevant to the previous year succeeding such previous year, not in accordance with the provision of subsection 1. Let me say in 18-19, they have come out of the 4480. He shall not be eligible to claim the benefit of the provision of this section for 5 years subsequent to the assessment year relevant to the previous year. So 18-19, then after for 5 years, they will not be eligible for 4480 benefit. So from 18-19 onwards, for 5 years you need to count. So 23-24 will also be covered in that 5 years. Because of that, section 4480 subsection 4 is applicable, and subsection 5 says you need to get your accounts audited. So I would say it is a 4480 will be applicable. Done? Again, would suggest don't go the answer. Don't refer the answers. Any queries are there? Please post the same in the chat box. And again, I'm repeating, what I'm saying is the one of the interpretation. You may find a different people who says this is the way also the provision can be read out. And I'm not saying they are wrong completely. But whenever provisions are not clear, it is a better to take a safer approach. Done? So I'm going for the next one. So from assessment year 18-19 to assessment year 20-23, person has a declared profit as per section 4480 subsection 1. And so now for 5 years they have declared a profit as per section 4480 subsection 1. Yes. Now whether conditions are fulfilled of this subsection 4, let's refer. Eligible assessee declared profit for any previous year in accordance with the provision of this section, and he declared profit for any of the 5 assessment year relevant to the previous year.
Excuse me, sir.
Sorry.
We have one doubt. Would you like to take it right now? Oh, sorry, it's not.
Let's
Later
take
on?
it at the end of the session.
Okay, thank you.
Okay. Now, if you refer only this part, what does it mean? It means for first year, declare profit as per section 4480, and for then after for 5 years, you have to be there in the 4480. So effectively, you have to be in there 4480 for 6 years. If that is a scenario, then this subsection 4 will not be applicable. Meaning thereby, you can come out of the 4480 after 6 years totally. Okay, so in this scenario, if in a 6th year is coming out of the 4480, person has a turnover more than 2 crore and have a profit less than 6% of turnover. Now in this scenario, whether in 6th year assess is coming out of the 4480 in this 6th position, 6th example, sorry. Now whether for sixth year, that is the assessment year 23-24, can he declare the profit as per section 44 AD? Answer is no, because provision itself says that your turnover should be less than 2 crore, but your turnover is more than 2 crore. So in this year, you are not eligible for 44 AD. It is not the case that you yourself is choosing to come out of the 44 AD. Am I clear? And because of that, it is my opinion, I have written clearly, it is my opinion that audit is not applicable due to section 44 AD 4, as assessee is not eligible for declaring profit as per section 44 AD. And you need to check the applicability of section 44 AB separately. So how we need to check? If your turnover is more than 2 crore, then the proviso will be applicable. Your receipts in cash and your payment in cash should be restricted to 5% of total receipt and total payment respectively. If that conditions are fulfilled, even in this case, 44 AB audit is not applicable. If these conditions are not complied fully, then 44 AB audit will be applicable between 1 crore to 10 crore. Done? Now let's take another example. 1890 to 2023, person has a declared profit as per section 44 AD subsection 1. And in this year, person has any amount of turnover but having a commission income. Or let me say they are converted into LLP or company. Or they've claimed this deduction. If that assessee has claimed this deduction, they are now not eligible for the 44 AD benefit. In that scenario, again, interpretation or conclusion will be same, that in sixth year, again, it is not the assessee who has come out of the 44 AD, but rather because of the provision, they are now not eligible for 44 AD benefit. And that's why it is my opinion that 44 AD subsection 4 audit is not applicable. Again, I'm repeating, there is still confusion or different interpretation is possible. Again, would request to all the participants, if you had a query, please post the same in the chat box. We will take the queries very shortly. Done? Now, last. And in this year, for example, what is the condition? This is the first. From AY 1819 to 20 to 23, person has a declared a profit as per section 44 AD subsection 1. And in 23-24, this is, in this year, person has a turnover less than 2 crore and wants to declare a actual profit. Then audit is applicable because of due to section 44 AD subsection 4. Answer is yes. Why? Because in sixth year also, up to sixth year, they need to be there in the 44 AD. Is that clear? Now moving to the last one. And in this year, person has a turnover less than 2 crore and wants to declare a actual profit which is less than 6% of turnover, but total income is less than basic exemption limit. Now, let me say you are actually in the sixth year not complying the 44 AD provisions. So whether audit is applicable, answer is yes, but there is one restriction in subsection 5. Notwithstanding anything contained in the foregoing provision of this section, an eligible assessee to whom the provision of subsection 4 are applicable and whose total income exceeds the maximum amount which is not chargeable to income tax. Meaning thereby, if your total income is less than the basic exemption limit, then the subsection 5 audit is not applicable. Okay, so in our example, whether total income is less than basic exemption limit. Now this basic exemption limit is applicable only in case of individual and HUF. If they are partnership firm, there is a no basic exemption limit. So this scenario is not applicable for partnership firm. This scenario can be applicable only for individual HUF whose income is not taxable up to 2.5 lakh. If that is the case, whether audit is not applicable? Yes, because their income is less than basic exemption limit. Whenever we refer total income, it is a total income of all the 5 heads less deduction. That is what total income means. Is that clear? Now, would request to Aneri, can you share the details of the query?
Yes, sure, sir. So, the first query that has come is what is what if the assessee has been involved in business and also profession, whether he can take benefit of 44 AD or 44 ADA combined or separately?
Done. So answer to your query is something like this. First of all, let's talk about the practical point of view. As of now, if you file the ITR form applicable for 44 AD and 44 ADA, you can declare both the income simultaneously in the return, wherein you can declare the 6 or 8% of the turnover under section 44 AD, and you can declare 50% of the turnover from profession under section 44 ADA. Return will be filed, it will be processed perfectly, but it is not allowed. Why so? Let's refer this proviso. Provision of this section, notwithstanding anything containing the foregoing provision, shall not apply. So the section 44 AD will not be applicable, or benefit of 44 AD cannot be taken in the following scenario. First, a person carrying on profession as referred to in subsection 1 of section 44 AA. So 44 ADA is applicable only if you having an income from the specified profession, what is referred over here. In that scenario, over here they have not said that this benefit of this provision is not applicable for the receipts of profession referred to in 44 AA subsection 1. It is not applicable to the person. So if you are a person having a income from a specified profession as referred to in section 44 AA subsection 1, then benefit of 44 AD is not applicable. So I would request you don't take the benefit of 44 AD. And what will happen? Answer to a further thing. As of now, though CPC Bangalore is processing the return perfectly, there are very higher chances that they may open the assessment of the assessee later on who had declared the income under 44 ADA and 44 AD, and they will then after claim that this benefit of 44 AD is not available. So maintain the books of account. Have you maintained? Answer is no. Then pay the penalty and declare the actual profit. That's the way they will proceed. Again, I'm repeating, still as of now, if you declare income under both the section 44 AD and ADA, return will be filed and processed perfectly. Still, as per law, it is not allowed, and they will take the action whenever it is came into their knowledge. Another query, please.
Okay. So next question is, even for a private limited company, if turnover is 3 crore and cash transaction is lesser than 5%, audit is not required?
Okay, done. Let's take a from the basic. First of all, whether 44 AD is available to private limited company, answer is no. Why? Because eligible assessee means individual HF and partnership firm. It does not include LLP. So first of all, benefit of 44 AD is not available to private limited company. That is clear. Now let's go for 44 AB, which talks about the normal audit, to whom 44 AD is not applicable at all. So in that scenario, every person carrying on the business, if turnover is more than 1 crore, audit is applicable. Then after they have put a proviso. In the proviso, they have said that cash payment and receipt is restricted to 5%. Just a minute. Provided that the case of a person whose aggregate of all amount is so and aggregate of all payment made including amount in so, this clause shall have effect as if for the words 1 crore, the word 10 crore rupees had been substituted. So benefit of this proviso is applicable to all the person, including private limited company. So yes, in case of the private limited company, if that turnover is less than 10 crore, in your case 3 crore, and their cash payment and cash receipt is restricted to only 5% of total receipt and payment, then audit is not applicable. Let me put another conclusion. There will be scenario wherein a particular individual whose turnover is less than 1 crore, still audit could have been applicable because of 44 AD subsection 4. And there will be instances where turnover is less than 10 crore, still audit is not applicable. So don't ask me about the logic. Sometimes when you are trying to make a interpretation of the provision perfectly, logic is take the backward seat and only provision is interpreted. Done. So yes, in your example, audit will not be applicable because of the proviso of clause number A of section 44 AB. Please, next.
Okay, another query coming up is assessee has turnover below rupees 1 crore and profit below 6% or 8%, but above maximum limit chargeable to tax. Will tax audit be applicable?
First of all, before I could give the answer of your query, again, turnover is less than 2 crore.
1 crore.
Sorry, turnover is below 1 crore and profit is below 6 or 8%. And
Yes.
their income is more than exemption limit.
Maximum limit chargeable to tax, it is above that. Yeah.
Okay, done. So in this scenario, first of all, we need to check whether in earlier years you have taken a benefit of 44 AD or not. If, let me take a first scenario, if in earlier years you have not gone for 44 AD at all for last 6 years at least, then in this year 44 AD is not applicable because 44 AD is applicable by choice of the assessee in first year. Okay, so you have not gone for 44 AD in earlier 6 years at least. So in this year 44 AD has no application and only applicable section is 44 AB. And 44 AB, under 44 AB, audit is applicable only when your turnover is more than 1 crore. But in your case, your turnover is less than 1 crore, and that's why audit will not be applicable. That is the first scenario. Second scenario, that let me assume in last 6 years you have gone for 44 AD. So you need to check whether that 6 years are completed or not. For 44 AD you have gone for, and after that within 5 years you have come out of the 44 AD. So in that case, as per section 44 AD subsection 5, what I'm referring is this part. So I would request to that person, please give them more information so we can decide it perfectly, or either I can give the answer perfectly. Another query, please.
Okay, so another query is quite large, so I'm putting in the chat box. You can
Please.
just read it.
That will be great.
It's related to partnership firm.
Okay, I'm just reading the query. And the query is visible to participants?
No, not this one.
Okay, done. So chat box is not visible.
I doubt so.
Okay, done. So I'm just reading the query to for every participants. Partnership firm is there. Turnover is 18 lakh. Profit is 45,000 after partner remuneration and interest. That means less than 6%. In the last year, ITR 5 with full balance sheet is filed. Not opted for presumptive 44 AD. Is audit required in current financial year? Again, for this scenario, if you really if you really need a right answer, let me know that in earlier 5 or 6 years, have you gone for 44 AD? Let me take a scenario. If assessment year 18-19, you have gone for 44 AD benefit, and then after you have come out of the 44 AD, then for next 5 years, you cannot go for 44 AD, and you need to get your accounts audited for 5 years. That's what subsection 5 says. If, let me assume on a scenario, if in earlier 6 years you have not gone for 44 AD, not for last year, and then this is the scenario that your turnover is 18 lakh, profit is 45,000, then doesn't matter what is your income is it is a less than 6% or not, 44 AD is not applicable. So only applicable section is 44 AB. And as per 44 AB, your turnover is less than 1 crore. For business case, audit is not applicable. Whatever profit is there, you can declare it. Is that done?
Okay. Okay, one last right now so far.
Just a
Yes.
a humble request to all participants. Please put a fact that in last 6 years, have you gone for 44 AD benefit or not? That is necessary to answer your query perfectly. Please go ahead.
Okay. This question is again on partnership firm. First year of business, turnover 25 lakhs, loss of 1.5 lakh, not want to opt for presumptive taxation. Is audit required?
Can you send me in the chat box?
Okay.
Done. So partnership firm is there. First year of business. There is a first year of business. Great. So 44 AD have not benefit of 44 AD is not taken at all. Turnover 25 lakh. there is a loss of 1.5 lakh, not want to optate for reserved taxation. Is audit applicable? So whether 44 AD is applicable at all? No, because it is the first year. Now, which section is applicable? Only applicable section is 44 AB. Now, in that case, when audit is applicable, when your turnover is more than 1 crore. So that's why in this scenario, the audit will not be applicable because your turnover is less than 1 crore. Whether it is a loss or profit or whether income is more than 6 or 8%, it is not relevant at all because 44 AD is not applicable. Okay, so it is answered. Any other queries are there?
No, so far.
Done.
Yeah, you may proceed.
See, would again like to repeat that 44 AD audit is applicable only when you have chosen the benefit of 44 AD in 1 year, and within the next 5 years you have come out of the 44 AD. Again, I'm repeating, the audit under section 44 AD subsection 4 is applicable only when in the first year, for example 17-18, you have gone for 44 AD benefit, and within the next 5 years, for any 5 years after that, you have come out of the 44 AD. Though your turnover is less than 2 crore, you are otherwise eligible for the 44 AD benefit. In that scenario only, the benefit audit under section 44 AD subsection 4 is applicable, not otherwise. So let me take a scenario that the one person who had declared the profit under section 44 AD for first year, and then after he also declared the profit as per section 44 AD for next 5 years. So first year 44 AD, after that 5 years means second, third, fourth, fifth and sixth year. Up to sixth year he has declared a profit as per section 44 AD subsection 1. Now in seventh year, can he come out of the 44 AD without the audit? Answer is yes. That's the way you need to interpret the provision. Any queries there? For this part, let me know. I'm simply reading the provision. And I again wanted to mention that there is a confusion. What is the confusion? That if you read whole section 44 AD, now section start with notwithstanding anything to the contrary contained in section 28 to 43C. Now over here, section 44 double A is not covered. So my first question, whether books of accounts are required to be maintained if you have gone for 44 AD, normally answer should be no, books of accounts are not required to be maintained because we are going for 44 AD benefit wherein a profit need to be declared at a presumptive rate. And even a ITR form has no option to fill up the balance sheet P&L, or rather ITR form is not compelling us to fill up the balance sheet P&L. But if you refer the section completely, then there is no clarity is given completely that you are not required to maintain the books of account. Yes, they have mentioned that if you come out of the 44 AD, then you need to maintain the books of account. So indirectly they have mentioned it, not directly. Done for this part? Any other queries are there? For this part, let me know the query in the chat box. Now I'm directly moving to these some very few amendments are there which you need to be careful while filing the return for assessment year 20 to 23. There are lots of amendments are there, but I have tried to keep the amendments only for those parts which are useful for filing the return. Done? The first thing is this. Now this is section 115 BBI introduced. First of all, let me give you the background. If your clients are the trust who are now registered under section 12AB, because they are registered in section 12AB, what benefit is available? Out of rupees 100 of receipt, they need to spend the 85 rupees for the purpose of the charitable trust, and on remaining 15 rupees they will not be asked upon to pay the tax. That is what the benefit is available under section 11 if trusts are registered under section 12AB. Now what was happening earlier, that if a trust is having the, for example, 10 lakh of receipts, what amount they need to spend? 85%. But let me say they have spent not the 8,50,000, but they have spent only, for example, 6 lakh. So 6 lakh amount spent out of 10 lakh, remaining amount is 4 lakh. out of 4 lakh, 15% is not going to be charged because of section 11 benefit. So 1.5 lakh, that is 15% of 10 lakh, will not be charged to tax. That is so now out of 10, 6 lakh rupees is spent. Rupees 1.5 lakh is not charged to tax because 15% of a total receipt. So now remaining amount is 2.5 lakh. Earlier, if you file the ITR 7 and your trust is registered under section 12AB, up to 2.5 lakh, they are not going to charge any tax. Why? Because trust, though registered under section 12AB, is eligible or liable to be taxed at a slab rate which is applicable as per AOP, that is a section 164 subsection 2. So earlier, up to 2.5 lakh, in our example, 10 lakh is a receipt, 6 lakh is the amount spent for trust, 1.5 is the 15% of the receipt not chargeable tax, on remaining 2.5 lakh, there was no tax payable because trust was taxable as a AOP, wherein benefit of basic exemption limit is available. But now, because of section 115 BBI, if you refer that section, they have indirectly said that benefit of slab rate will not be available. So now if you are thinking that your trust registered under section 12AB is eligible for a benefit of a slab rate or at least a basic exemption limit of 2.5 lakh, that itself is a doubtful or rather not available as of now. So try to fill up the return ITR 7. They will tax, if you have not spent the 85% of the income, they will tax the remaining income at the rate of 30% directly because of section 115 BBI. So please, so what will be the another course of action? So in the section 11 itself, options are given to file the form number 9A and form 10. If your trust is not able to spend 85% of the receipts, form 9A is basically can be filed when out of 100 rupees, some amount is actually not received, but though accounted as a receipt because of the mercantile system. So you can file form number 9A, and then that's the way you can say that remaining amount of difference will be spent in the next year. And form 10 is applicable, that you can file the form by saying that we will spend the difference within the next 5 years. So let me, for form number 10, let me take a simple example. Out of 10 lakh, I have spent only 3 lakh rupees. So how much I need to spend? 8 lakh 50,000, that is a 85%. So what is the difference? That is 5 lakh 50,000 I have not spent. So I can file the form 10, wherein I can ask them, I can file the form by which I can say I will spend this 5.5 lakh within the next 5 years. And for that time period, up to that time period, I need to invest that 5.5 lakh into the fixed deposit of the nationalized banks. And I need to spend that amount within 5 years. That's the way you can plan out the things. Now, lots of people had a query whether section 115 BBI will supersede the section 164 subsection 2. Prima facie answer is yes. This section will override section 164(2), and because of that, now your trust is not eligible for taxation at a slab rate. So please be careful. And one more thing, I need to abide it by time, just let me know. Now, next thing, I think I have 5 minutes. And next thing, if you refer the amendment made by Finance Act 2023, form number 9A and form number 10 need to be filed before 2 months from the return filing date. So your return filing date is 31st of October 2023. So before 2 months is 31st of August. So within a 14 days. But then after, some people have made a representation. Because of that, government has issued a circular number 6 2023, wherein different aspects related with the trust are discussed. In that circular, they have granted the assurance that you can file form number 9A and form 10 within a due date of income tax return file. Meaning thereby you can file this form up to 31st of October 2023. But please note down this circular number because there are good chances that CPC Bangalore may not understand these things. So they may process the return with the demand. So you need to file the rectification along with the by informing that this circular is applicable. Is that clear? So I have referred all the amendment made by Finance Act 2022. As far as the amendments are concerned, they all are procedural or helpful in the tax planning or in the scrutiny assessment. it is not helpful for the return filing, except the second one, 14A disallowance. If you have a client who is spending the expenditure, who have expenditures are incurred for taxable income as well as for the exempt income, then 14A disallowance is applicable, because you are claiming expenditure which is expenditure incurred for earning exempt income. In that scenario, there is one judgment of the Gujarat High Court in Kotak Energies, wherein they have said that if there is no exempt income actually earned during the year, then 14A disallowance is not required to be made. Now that judgment is overruled by the amendment. So though there is expenditure incurred during the year, for example, brokerage charges or demat charges. Now demat charges are incurred for shares or demat account. Out of demat account, what you are doing a transaction in shares. Now shares have a exempt income up to 1 lakh at least, and there's a taxable income of short-term capital gain and the dividend. Now, whether you can say that expenditure of demat charges is for purpose of exempt income, yes, because demat charges are for income from shares. In that scenario, if there is no exempt income earned during the year, still you need to calculate the disallowance as per section 14A. What I'm trying to say, just because in the year there is no exempt income, you cannot say that disallowance under section 14A is not applicable. That's what my point is because of the amendment. Done? Now, any queries there?
Yes, we have queries. Shall
Please
we
go.
take them?
Yes,
Would you be comfortable me reading it, or should I post it in the chat box?
chat box would be perfect for me.
Okay.
So, query something like this. If a return is processed for 44 AD and 44 ADA in past year, however, as per law, I cannot take a benefit of 44 AD. Then to come out of 44 AD, should I need to do the audit? First of all, you have filed the return by claiming a 44 AD and 44 ADA. Okay, so which was earlier, you cannot go for 44 ADA. Now in this year, there are two interpretations. First thing, in first year, 44 AD is not applicable. That's why you cannot come out of the 44 AD. If that is the interpretation, audit is not required, because actually you were never eligible for 44 AD. Second interpretation, what assessing officer can take, that though you have got, though it was not eligible, you have taken a benefit of 44 AD. For 5 years, you have to be in 44 AD. And as you have come out of the 44 AD, audit is applicable as per section 44 AD subsection 5. So both the options are true, but I would suggest, as there is no clarity, better to get the accounts audited as per section 44 AD. Again, I would like to clarify, there is a lack of clarity in 44 AD. That's why it is better to be on the safer side. If assessee wanted to take the risk, or you as a professional wanted to take the risk, it's completely your call. Thank you. Next, please. Next query is 44. If individual having a 60 lakh turnover, not declaring profit at the rate of 8%, have not opted for presumed taxation in last 6 years. Whether audit is applicable, answer is no. Because 44 AD is applicable, no. So only applicable section is 44 AB. And your turnover is less than 1 crore, and that's why audit is not applicable. Simple. Done? Okay, there are queries.
Here
Okay,
comes the next. Yes, we have last.
Done. 3 years return filed with the income from business offered under section 44 AD. Fourth year, no business. Fifth year, just a minute. Fifth year, can 44 AD applicable, or one can claim that since no business in fourth year, 6 years conditions not applicable. I would suggest in fifth year, if you have a business income, go for 44 AD, presumptive taxation. Because assessing officer, if caught, if you are selected for scrutiny, because 99% or 99.95% cases are never selected for scrutiny, normal scrutiny. So I would suggest you in a fifth year, as you have business income, please declare the profit as per 44 AD. If you take a plea that as in the fourth year there is no business income, and in the fifth year you can come out of the 44 AD, that interpretation may not be taken by AO. And one limitation of this part, 44 AD is basically have a problem only for audit. And if you have not get your accounts audited, what is the penalty is 1.5 or something like that. Yes, your applicable penalty is very less. So in this kind of cases are normally, normally SSC don't go for appeal till tribunal. And if no one file the appeal till tribunal, those judgments are never going to be reported, because only tribunal judgments are reported, not of CIT appeal. So this situation will be clarified only by judgments or maybe by amendment. So getting a clarity is a very difficult in the near future. Next, please. Okay, I'm taking the last query. Remaining query, I think we need to skip because of the time limit. Trust is required
This
to
is
file
the
ITR
last one.
Done. Thank you. Trust is required to file ITR 7 even if receipts are 50,000 only and unspent amount is 40,000, and any clarification on audit report of trust from 10 BB. First of all, if your trust is registered under section 12AB, yes, ITR 7 will be applicable. If your trust are even if receipts are 50,000 only, yes, ITR 7 will be applicable if they are registered under section 12AB. If they are not registered under section 12AB, then legally ITR 7 is applicable because of section 139 subsection 4A, but they process the return in a wrong way. That's why practically people are filing ITR 5, wherein they are showing the share of the trustee as a 50-50%, and returns is perfectly processed, though it is a legally wrong, but there is a practical solution. As far as the forms are there, forms are yet not notified, but yes, they have changed the form number 10B and 10 BB, depends how much your turnover is. So we are done with the query. Hope that some value addition I have put, and I have tried to reduce your doubts at some extent, though I cannot reduce in a zero because of the type of section it is. So thank you again for allowing me to speak over here, and thank you everyone, including Aneri. Okay, done.
Thank you so much, sir. I would just like to share a few words and of gratitude for you taking your time out. Again, ending with one quote by Anne Landers: "A person does not know how much he has to be grateful for until he has to pay taxes on it," right? So we all know how income tax and other taxes in our country are important on each and every person's life. And thank you, sir, for uh, sharing your expertise on the depth of income tax and for this webinar. I would like the next moderator of the session, CA Shanisha, to take over the webinar ahead for the second topic from Binoy Parikh. Thank you so much.
Thank you.
Am I audible?
Yes, yes.
Yes. Okay. Good afternoon to everyone. Okay. I hope you all have enjoyed the last session of the Devyangsha, and now we are move on the merger and acquisition of India. In India, the sessions taken by our Binoy Parikh sirs, and I'm honored to introductions about the Binoy Parikh sirs. He cleared all level of C exams in first attempts. He is authorized authors in various articles in relation to merger and acquisitions and succession planning on topics such as implications of hybrid acquisition through mergers, transitory accounting in case of acquisition, etc. Have been a speaker on various physical online webinars organized by ICAI, TechSutra, and Losico. And if within the sessions, if any queries rise, then you can put the drop and the message in chat box, and end of the session we will take all the queries. And definitely Binoy sirs is a good knowledge in merger and acquisition in India, and I hope you all enjoy the sessions of the Binoy Parikh sirs. Vinay Parikshars.
Right. Thank you so much, Honey, for that introduction. And without wasting much time, let me just share my screen. Yeah. Is my screen visible?
Yes, sir.
Okay. So what I've done for the next 1 hour or so is that I've divided the session into two parts mainly. The first part is just a general introduction to the M&A scenario in India and what causes, what impacts the M&A in India. And then to understand this much better, what I've done is that I've taken up about 7 case studies dealing with listed and unlisted companies undertaking mergers and acquisitions in India, and tried to analyze it not only from a tax perspective, but what could be the commercial considerations and regulatory considerations also. So obviously, if you have any queries towards the end of the session, we'll be happy to take those. Right. So as I was mentioning, M&A in India is not only something to do with only tax. It has to do with a waterfall, which we usually call as the CRT waterfall, commercial, regulatory, and tax waterfall. So basically, any M&A in India is driven by commercial objectives, commercial considerations. Thereafter, there are a host of regulatory aspects which impact any M&A deal in India. If it's a listed entity, then SEBI regulations. If there are non-residents or foreign companies involved, then FEMA regulations. If Ind AS is applicable, then accounting under various Ind AS, company law specifications, and any other sector-specific regulations. For example, in the recent case of Zee Sony, a Ministry of Information and Broadcasting would have been applicable. So any sector-specific regulations would also impact any M&A in India. Once the commercial objectives are addressed, once the regulatory aspects are addressed, we then move on to analyzing the tax and fiscal implications on that. Largely, when I say tax, it mainly refers to Income Tax Act. GST is largely not applicable in almost all the scenarios. But one important aspect, and I've tried to bring this in, is the fiscal cost in terms of stamp duty. Because stamp duty is something which is applicable on the value of transaction. So the larger the value, the more the fiscal implication in terms of stamp duty. So as I was explaining earlier, there are a whole host of various regulations. If it's a listed entity, then of course, first and foremost, you have SEBI regulations. Within SEBI, there are listing obligation and disclosure requirement regulations of 2015. These get updated from time to time. A whole host of regulations and disclosure norms came in as recent as July, and we'll be touching upon some of them as we move forward. The second and the main circular which deals with any scheme of arrangement dealing with mergers or acquisitions is SEBI Master Circular on Schemes of Arrangement dated 20th June 2023. Thereafter, it provides, thereafter you have to analyze various implications under the SEBI Takeover Code. And insofar as mergers or demergers or slump sale or any scheme of arrangement is concerned, then there are certain general exemptions which are provided. Moving on, insofar as listed and unlisted companies both are concerned, you have Companies Act governing schemes of arrangement, more particularly Section 230 to 232 of the Companies Act, Section 234 if it concerns a cross-border merger. Stamp duty, as I said, is applicable for both listed and unlisted companies, and it is linked to the value of transaction. So this could result in a very heavy cost, especially if there are states which have a very large upper cap or which have no upper cap. For example, Maharashtra has an upper cap of 50 crore rupees, which is in itself very large. It was 25 crores pre-COVID, then they increased to 50 crores. Gujarat, I believe, has an upper cap of 25 crores, and there are some other states which have an upper cap. But there are various states, for example, Delhi, which still follows Indian Stamp Act, it doesn't have an upper cap. So it is directly linked to value without an upper threshold, resulting in a potentially very high stamp duty cost. Income tax, unlike the host of complexities which the earlier speaker dealt with, insofar as mergers and acquisitions is concerned, if a certain set of parameters are followed, largely mergers, demergers are tax neutral. If it's a slump sale, it is taxable and it is subject to capital gains tax. But there are set norms and set formula pursuant to which capital gains tax is computed insofar as slump sale is concerned. Moving on, if non-residents are involved, or if there is any company which is either foreign owned and controlled company or foreign shareholders are involved, then whole host of FEMA regulations kick in. Largely, again, if any involved company, if any transferor or transferee company is in an automatic sector, then there are not many conditions to be complied with. But there are certain nuances which we will look into as we move forward as a part of our practical case studies. Last, Ind AS, of course, now with Ind AS kicking in since 2016, it's been 7 years and a lot of developments have happened over the last 7 to 8 years. But the two main Ind AS which impact any recordal of transaction in the books of the transferee company or the transferor company in case of a demerger or slump sale is basically Ind AS 103 dealing with business combinations, and Ind AS 109 and 32 dealing with financial instruments. Let me give you a simple example. For example, let's take up a case of redeemable preference shares. Two companies merge, preference shares are issued, end of matter. But if Ind AS is applicable, it complicates a lot. For example, in the books of the transferee company, redeemable preference shares will be treated as debt under Ind AS 109. It will be treated as share capital under Companies Act. It will be treated again as share capital and the consideration discharged for the purposes of stamp duty. But again, coming back to FEMA, if preference shares are issued to non-residents, they'll be treated as a debt instrument and you'll require an RBI approval. From a SEBI perspective, if these are convertible instruments, then they'll be only treated as equity as and when they are converted. So, one instrument, the point that I'm trying to highlight is that one instrument can have multiple implications under various laws, and the way a transaction is recorded will vary significantly. For example, the example that I just gave, redeemable preference shares can result in a huge debt being recorded in the books of a company. So, we need to be cognizant that, accounting earlier did not used to have so much of relevance, but now the way a transaction is recorded will impact the balance sheet for the years to come. So with this broad overview, let's move on. What could be the modes and objectives of an M&A in India? So on the left, as you would see, there are various modes of M&A in India, especially through schemes of arrangement. Amalgamation, where two companies merge, one company goes out of existence. Demerger, where a part of a company, which is, let's say, if there are two businesses, one business is demerged and housed into a separate company. That's a demerger. Slump sale or a slump exchange, basically, again, a part of a company, a business, for example, is hived off, but the consideration is received by the transferor company itself. Now, one would say that, a slump sale could also be done through a business transfer agreement outside of a scheme of arrangement. But most of the times and in most of the cases, especially Gujarat and Maharashtra, stamp duty on slump sale through a scheme of arrangement is much lesser. Therefore, one would prefer to do a slump sale through a scheme, even though it requires an NCLT approval and therefore elongated timelines. Capital reduction is basically a balance sheet right sizing. To put it very crudely, it's like a liposuction where the excesses of losses are written off against share capital or credit reserves. You could always have a composite scheme involving any or all of the above. For example, it could be a combination of amalgamation, demerger, slump sale, capital reduction, and there's no bar on how many transactions can be undertaken pursuant to one scheme. Insofar as the objectives are concerned, we need to be cognizant of the fact that mainly there are two types of structurings. One is an internal group restructuring and one is an external structuring. Insofar as the internal group restructuring is concerned, it could be undertaken for the purposes of facilitating divestments, for the purposes of facilitating family settlements, segregating businesses which have different risk-reward profile. For example, you could have a business which has a textile division and a real estate division. Textile and real estate really have nothing to do together. So the risk reward profile is different. So might as well segregate it. Balance sheet right sizing, we saw a liposuction of excess losses against reserves. And it could simply be a group simplification or consolidation where you have a whole host of entities merging into a single consolidated entity, reducing administrative overheads, multiplicity of entities, etc. Insofar as external restructuring is concerned, again, it could be various reasons. In the textile and real estate example that I gave, for example, you may want to surface the value of textile business, and therefore you are segregating it, unlocking the value of the textile business, and then seeking strategic or financial investors in that business. It could be, for example, for a potential exit structuring. I remember that one of the Gujarat-based companies, Arvind Limited, had sought to list Arvind Fashions, which is listed today. It had multiples private equity as an investor owning about 11% in Arvind Fashions, and it wanted to give an exit or at least a liquid currency by way of a listing to multiples. And therefore, it got its fashion division listed. In case of distressed acquisition, also there could be a potential. I'm not talking about IBC cases because that's driven by a separate IBC process, but there could be distressed acquisitions where a loss-making company is acquired by a larger company. Fundraising, segregating non-core businesses, and there are various objectives we'll see through the case studies over the next 45 minutes or so. Right. So over the next 7 case studies, what I've done is analyzed the commercial objectives and considerations of a particular deal, then analyze what could be the potential regulatory implications around that. And of course, then I've gone to analyze the tax implications on that. So the first and the foremost, and it was quite in news recently, hence I took it as the first case study, is basically the merger of Zee Entertainment with Sony Picture Networks. Now, the facts of the case are on your right on the screen. Zee Entertainment, which is the company in orange, public shareholders held 96%, 4% was held by the SL Group promoters. The companies in gray are a part of Sony Picture Networks. We can ignore BEPL for the moment because it's a small unlisted company. It's mainly the merger of Zee Entertainment with Sony Pictures. So we can focus on that. So Sony Picture Networks was held by a Singapore holdco. The broad contours of this scheme of arrangement was a simple merger between Zee Entertainment, a listed company, with Sony Networks, an unlisted company. And as a result of which, Sony Networks would become listed automatically without undertaking an IPO process. So listed company merging with an unlisted company is the broad picture of this scheme of arrangement. And Sony will get listed. Sony will issue shares to the public shareholders of Zee Entertainment and to the SL Group promoters. Now, there are 2 main sub-steps to this transaction. Step 1 on your left, if we see, there was restructuring of share capital of Sony Pictures prior to the scheme becoming effective as a part of the same scheme in the form of subdivision, bonus, rights issue, but that is not really relevant for the purposes of our discussion. One important aspect was that there was a preferential issue of Sony Networks' own shares to SL Mauritius and SL Mauritius SPV. Basically, these were companies which were held by the SL Group promoters. And this preferential issue, basically, the SL Group promoters would pump in money into Sony Pictures, against which new shares will be issued prior to the merger. This preferential issue was effectively funded by way of a non-compete, and this is very important from a tax perspective, as we'll see in the next slide. This was funded by way of a non-compete paid by the Singapore holdco to SL Mauritius. So it was a transaction outside India, paid by one foreign company to a Mauritius company, a non-compete fee for the business which was undertaken in the Indian territory. So we'll come to the tax implication of that, but the same money then was utilized for the preferential issue of new shares to the SL Group promoters by Sony Network just prior to the merger. Now, remember that I referred to the concept of composite schemes of arrangement, and this is one part of it, that preferential issue was done through this composite scheme of arrangement. Step 2, relatively straightforward in terms of conceptual understanding. Amalgamation of Zee Entertainment, a listed entity, with Sony Picture Networks, and Sony Picture Networks getting listed. What was the rationale? The rationale was that the combined market coverage would cover more than 50% all India. It would create the largest media company in India. The relative value for swap of shares was decided to be 260 per share for Zee Entertainment and 305 per share for Sony, which translated into roughly about 25 to 26,000 crores of market cap at this valuation. The post-merger shareholding basically was Sony Group will hold 51%, Zee Group holding will be 4%, and balance 45% will be held by the public shareholders. 4% retention by Zee Group was, as I said, a combination of two things: preferential issue of shares by Sony Pictures to SL Group promoters, and as a result of issuance of new shares by Sony Pictures to Zee Group promoters. There were various shareholders and management arrangements between Sony Group and SL Group, including the fact that both, to start with, Zee Group and Sony Group will be classified as promoters. Continuation of Zee Group MD as the MD of the merged entity, but with various restrictions. The third major restriction was that now SL Group cannot, or SL Group promoters cannot acquire any additional shares which results in transfer of control or significant influence or in excess of 10%. The composition of board, of course, to give more preference to Sony Group was decided with observer status given to Zee Group members. Now we come to when was this scheme made effective. Now we all know that the NCLT order came a few days back, but what was the appointed date? So appointed date is the concept where basically all the assets and liabilities are deemed to have been vested with the transferee company. So all the assets and liabilities of the transferor company are deemed to have been vested with the transferee company. That is the meaning of an appointed date. Now, appointed date can be a retrospective one. So if the NCLT order, for example, even if the NCLT order comes in August of 2023, it could be made effective with retrospective effect from 1st April 2023. But that was not the case over here. Here, the case was that appointed date is equal to the effective date. Effective date effectively is the operative date when the NCLT order is filed with the Ministry of Corporate Affairs. So in this particular case, an appointed date will be a prospective one to the order of the NCLT. So let's say August, the order was received, order was passed, it is received sometime, let's say towards the end of August, then and they make it effective by filing INC 28 with MCA on 31st of August. So 31st of August will be the deemed appointed date when the merger becomes effective. Coming to the commercial, regulatory, and tax considerations. Commercial considerations we spoke. This is a consolidation of businesses in the same space. Most important is the second point, that Sony Group effectively acquired the business of Zee in a cash neutral manner. Why? Because Sony issued only equity shares to the shareholders of Zee, and there was no cash outflow for Sony Group, except to the extent of the non-compete fee. But largely for acquisition of the business, it was cash neutral. Coming to the regulatory considerations, any merger involving a listed entity requires a prior SEBI approval, post which NCLT approval is required. And within the NCLT approval, there are a whole host of approvals in the form of regional directors approval, official liquidators approval. So the timelines can get really elongated. Typically, in a non-complicated merger, not the size of Zee and Sony, it still takes about 12 months, basically divided post the board meeting, divided into 3 months for 3 to 4 months of SEBI approvals, and 7 to 8 months of NCLT approval, followed by 1 or 2 months of listing of an unlisted entity. One important point over here is something which is called as the MOM approval. So majority of minority approval. So SEBI circular, which I referred to earlier, 20th June 2023, provides for 5 specific scenarios where the listed entity has to approach its public shareholders for approval and the promoters cannot vote on it. Here, of course, the promoters were only 4%, so it wouldn't have mattered anyway. But this becomes important where the promoters are in majority. This is one such scenario, because what happens is, one scenario which is prescribed is as if the listed company's public shareholders are diluted by more than 5%, then the approval of public shareholders of the listed entity is required. Now we saw that public shareholders in Z were 96%. They were diluted to 45% in terms of percentage, not in terms of value. So majority of minority approval of the public shareholders was taken. The second point over here is that Sony will become automatically listed on the stock exchanges without going through an IPO process. Minimum public shareholding norms are to be complied with, it, which obviously is being complied because minimum public shareholding is 25%. Public shareholders would be at 45%. One important point is that because this merger is through a scheme of arrangement, and even if it results in acquisition of business of Z by Sony, there is no trigger of open offer because takeover code specifically exempts any merger directly involving a listed entity from the obligation to carry out open offer. In terms of Ind AS, we just discussed that Sony is the acquirer entity, and therefore acquisition method of accounting under Ind AS 103 would be applicable in the books of Sony. What does this mean? Is that all the assets and liabilities of Z would be accounted at fair values in the books of Sony. The consideration which is issued in the form of equity shares would also be accounted at fair value, split between face value and securities premium. And the difference between the two, let's say the fair value of assets and liabilities is 100 rupees and the fair value of shares issued is 150 rupees. Then the difference between the 250 rupees will be recorded as a goodwill. There are certain cases which we'll see where, whether if this can be allocated towards certain intangible assets or not, we'll see and we'll come to that. But largely 50 rupees is either recorded as intangible or goodwill or a combination of the two. Last, Competition Commission approval was sought. MIB approval, which I gave an example in the earlier slides, Ministry of Information and Broadcasting approval was required. In terms of the tax and fiscal considerations, merger, of course, will be tax neutral. But one important aspect over here is that what will happen to the cost to the shareholders who held the shares of Z, which is a listed entity, prior to 31st January 2018. So we know that capital gains on long-term capital gains on equity shares, listed equity shares, was introduced in 2018. But the government also provided that this is only applicable on gains which accrue post 31st January 2018 and not prior to that. So effectively, the cost was grandfathered. Now, the way the provisions are drafted, 55 to AC, it says that the shares should have been acquired, an emphasis on the word acquired, on 31st January 2018 for the grandfathering benefit to be applicable. Now, imagine a scenario over here where public shareholders or promoter shareholders have acquired the shares of Z, let's say in 2016. Now, these 2016 shares technically go out of existence and new shares of Sony will be issued. And therefore, the question is that these new shares were never acquired on January 2018. So should the cost of Z be grandfathered? Should I read the provisions constructively and harmoniously? Because effectively, the cost to the previous owner should be applicable. Logically, yes, but of course, express clarification would be required on this to rest this matter. But logically, it should be applicable because effectively the cost relates back to the cost to the previous owner. Yes, now the last point, non-compete fee paid in Mauritius, whether it is taxable in India. Here, the argument here, at least what I understand, is that non-compete fee which is paid in Mauritius, albeit it pertains to business carried on in India, it should not be taxable in India because let's take two scenarios. One, is it capital gains? The answer is no, because it's not really linked to sale of shares. There's no sale of shares which is happening. This is a merger. B, could it be business income? The answer again is no, because if SL Mauritius does not have a permanent establishment in India, then the taxability is only in the resident state, which is Mauritius, and therefore non-compete fee which is paid in Mauritius directly by a foreign company should not be taxable in India. So with that, let me move on to the case study number 2. Again, much talked about merger, Inox and PVR. The merger was approved a couple of months back, but then an appeal was filed by a group where it said that CCI should have taken cognizance of this and it should have examined this merger in further detail. So we'll come to that. But what is a transaction? Let's understand that first. So the transaction is basically between Inox and PVR, both being listed entities. If you look at Inox, Inox promoters held 44% in Inox Limited, 46% was held by the public shareholders. In PVR, 17% was held by the promoters, 83% by public shareholders. Inox Limited merged into PVR Limited. So here we have a case where a listed entity is merging into another listed entity, and PVR Limited, which is a listed entity, will issue shares to Inox promoters and public shareholders. Post-merger, Inox promoters will hold, or they currently hold as we speak, 17% in the merged PVR Inox. PVR promoters hold 11% and balance 73% is held by the public shareholders. What was the implied valuation? PVR was valued at close to 11,000 crores. Inox was valued at close to 6,500 crores, and the combined valuation was somewhere around 17,500 crores. Again, commercial considerations, as we saw in the Zee-Sony merger, it's effectively consolidation of businesses in the same space to especially achieve economies of scale. Again, while PVR acquired the business of Inox, it's a cash neutral transaction because the discharge of consideration is through issuance of shares. From a regulatory perspective, we saw that majority of minority approval here also will be required. Why so? Because the public shareholders of Inox are being diluted, the public shareholders of PVR are being diluted, and therefore majority of minority approval is required. Adding to the complexity of Zee and Sony, here we have two listed entities. So SEBI approval also will be required, subsequent to which NCLT approvals will be required. Here, it's interesting to note that there was no CCI approval which was taken earlier. And the reason was that they relied on something which is called as a de minimis exemption, which says effectively that if the turnover of the target entity Inox Limited is less than 1,000 crores, which it was, then you need not approach CCI. Effectively, the litigation right now, which involves, in fact, NCLAT, the appellate tribunal has given a favorable order. It says that CCI approval was indeed not required and things rest over there. So this is a very important exemption where, 1,000 crores obviously was a pretty large limit back then. So, this was an important de minimis exemption which Inox and PVR relied on. The argument which was held before, which was argued before the NCLAT, was that irrespective of the numbers, because Inox and PVR would result in consolidation of two large entities, it could potentially result in a material adverse effect on the competitive space from a qualitative perspective in India. But NCLAT dismissed this argument. We saw that in the earlier case also that Ind AS 103 acquisition method was applicable. Here again, PVR will issue shares to the shareholders of Inox, record the shares issued at fair value, record the assets and liabilities at fair value, and record the difference either as intangibles or goodwill. Now, there is an important aspect when I say that it could record as an intangible or a goodwill, and let me just explain that. So let's say the difference between the shares issued and the assets recorded is 50 rupees. Then out of the said 50 rupees, if specifically identified intangibles are recorded to the extent of, let's say, 40 rupees, then these 40 rupees, let's say, towards brand, your customer lists are not applicable, but whatever are the other specifically identified intangibles, if they are recording to the extent of 40 rupees, this 40 becomes a base for amortization under Section 32 of the Income Tax Act. Why? Because what was amended under Section 32 is disallowance of depreciation on goodwill, but not specifically identified intangibles. So while Smith Securities was overturned by this amendment, the amendment was silent on treatment of depreciation or amortization in case of specifically identified intangibles. And therefore, this becomes a very important point of consideration, that how do you allocate the difference between the fair value of assets and liabilities and the value of shares issued. And this allocation will obviously impact the overall tax computation post the merger. Especially when there are large brands involved, a specific brand valuation could perhaps capture the entire difference as a specifically identified intangible. The flip side to that, of course, is that if an intangible is recorded, it is subject to amortization even in the books. So if it is amortized in the books, especially for a listed entity, it could directly impact the EPS of the listed entity. So one has to balance out the two. There is a concept of a perpetually recognized intangible. For example, a brand. Let's say a brand is in existence since 100 years, and you don't see a brand depreciating in value over the next 100 years. Then effectively you cannot determine its life, and therefore it cannot be amortized. That is one line of thought, but most of the intangibles would be subject to amortization. So a balance needs to be traded upon when you are recording these specifically identified intangibles. Goodwill, on the other hand, is neither subject to amortization or available for amortization under the tax books, nor is subject to amortization in the normal books of accounts. Interestingly, the last point on the regulatory considerations, both the Inox promoters and PVR promoters are presently classified as joint promoters of the merged PVR Inox. And probably if tomorrow PVR promoters drop below 10%, then they may seek reclassification into public shareholders, which is a separate process under the LODR regulations, under Regulation 31A. From a tax perspective, again, we saw in Zee-Sony merger would be tax neutral. Again, the problem of grandfathering of cost would be there. But as I said, cost to the previous owner should be available, and therefore, even though the new shares of PVR Limited were not in existence on 31st January 2018, because Inox shares were in existence, the grandfathered cost as on 31st January 2018 should be available. One important aspect over here, especially when it concerns listed entities, is the stamp duty cost. Now, stamp duty is a state subject. So there'll be two incidences of stamp duty. One, in the state where the registered office of these two companies are situated, and two, on the immobile properties situated across state-wise. So here, points, at least in Maharashtra, it is 0.7% of the fair value of shares issued, which is effectively 0.7% of the value of PVR Limited, which is issued to the Inox promoters, prevailing as on the appointed date. So here the appointed date was 1st January 23. So whatever was the share price of PVR Limited as on 1st January 23, 0.7% of the fair value of shares issued will be subject to stamp duty, which is substantial. Again, if they have owned properties across various other states, which I am assuming they would, then they would be required to pay stamp duty in respective states on such immobile properties. So the cumulative effect of this could be substantial. Moving on, this is a case of hybrid acquisition. So here is a case where there is a listed entity on your left, and there is an unlisted company on your right. Now, the listed company wants to acquire the unlisted company. But from an acquirer's perspective, which is listed company's perspective, it wants it to be a non-cash and a tax-neutral transaction. So, of course, merger is the only way, as we saw in case study 1 and 2. But from an exiting shareholder's perspective, they want an assured price. What happens is that in case of a merger, equity shares are issued only after 10 to 12 months post the merger. So till then, and the valuation and the swap ratio is fixed today. So for the next 12 months, effectively, the shareholders who are exiting are taking an equity risk, because the market conditions can be anything when the merger is approved. So they want a partial assurance on the exit price, and therefore no equity risk. And therefore, the structure of this deal is like an hybrid acquisition. So as step 1, listed company would acquire some stake in the unlisted company for cash consideration. Exiting shareholders would pay capital gains at the rate of 20%. and receive cash against that, and therefore locking in their value partially. As step 2, unlisted company would merge into the listed company, against which the listed company would issue equity shares to the exiting shareholders. To this extent, of course, exiting shareholders would be taking a market risk. What are the regulatory considerations? As we saw, timelines and processes. SEBI stock exchange approvals will be required. NCLT approvals will be required. CCI approval could be required depending on the facts. One important aspect over here is that what are the implications under Ind AS? Let's consider a scenario where 51% stake in an unlisted company is first acquired, followed by merger of unlisted company into the listed entity. So immediately upon acquisition of 51% stake, listed company becomes the holding company of unlisted company and acquires control over the unlisted company. Now the principles of Ind AS state that whenever there is a merger of a company on which the transferor company already has control, then it is treated as a pool, it is treated as a common control business combination, and therefore fair valuation of assets of the unlisted company is not available. However, just contemplate upon the sequence of this transaction. There is a share acquisition immediately followed by a merger. So effectively, these two steps are a part of a composite kind of a scenario. And therefore, common control business combination specifically carves out a concept of transitory control, where effectively the control exercised by the exiting shareholders is being transitioned to the listed entity in a phased manner, but all these different phases are looked at as one single composite step. And therefore, despite the fact that it's effectively a merger of an unlisted company, which is a subsidiary of a listed company post-acquisition, it will not result in a common control business combination, and it would still be accounted as acquisition method and at fair values. We saw the fourth point, that the benefit of this is, of course, that the difference between the fair value of assets and liabilities and the value of shares issued will be recorded as intangibles in the books of the listed companies, and therefore tax amortization on these intangibles would be available. The balance, of course, residual goodwill is not subject to amortization either in the books or tax. But this is a specific scenario where, a choice of accounting under Ind AS 103 will drive the tax books of the listed companies in the form of amortization of intangibles in the books of the listed entity. Fiscal cost impact. Again, we saw that listed company would issue shares to the exiting shareholders, and therefore, at least in Maharashtra, it would be 0.7% of the value of shares issued. Value will be the market value of listed company prevailing on the appointed date. One important aspect over here is that while determining the share swap ratio, the valuation under various laws, for example, SEBI provides for a pref allotment guideline at a minimum floor price. FEMA also provides for an price determined as per internationally accepted pricing methodology. And tax provides for deemed floor price in the form of Section 50CA for unlisted companies, which this was so. All these valuation parameters need to be tied up when there is a two-step process, which is basically a share acquisition and a merger, because share acquisition requires actual cash consideration to be paid to the exiting shareholders. Merger would require obviously a share swap. What are the tax considerations? We saw that on sale of 51% stake by the exiting shareholders, it would be 20%. But interestingly, when the 49% is received, they'll receive shares of a listed entity. And therefore, if they sell the shares of a listed entity, and assuming it's long term, the capital gains on sale of these 49% shares, or the shares issued in lieu of these 49%, will be 10% as opposed to 20%. What will be the cost of acquisition? It will be basically indexation of the 2001 cost available till FY 2017-18. Again, this was introduced by Section 55 to AC. Whether there would be any implications under 21B, the answer is no. Merger is obviously a tax neutral merger. The fact that it was preceded by a share acquisition should not impact the merger itself, because the share acquisition itself was a taxable transaction. Last point is important. Now, what if there are pre-2017 Mauritius, Singapore, or Cyprus shareholders in the unlisted company? The reason why this is important is basically the fact that the respective DTAAs provide for the fact that if the shares were acquired prior to 1st April 2017, and if such shares are sold, then there is a grandfathering benefit available to such Mauritius, Singapore, and Cyprus shareholders. This treaty was amended, and which provided that if the shares are acquired post April 17, then any sale from these shares would be taxable. And therefore, this is a very interesting scenario, because let's say if the exiting shareholders had acquired the shares in 2016, those shares are getting extinguished as a result of merger. New shares are being issued. Now, these new shares are not issued prior to 17. Of course, they are issued, let's say, in 2023. And therefore, whether a grandfathering benefit would be applicable or not is a question mark. Unlike 55(2)(AC in the previous cases that we saw, where we can take a purposive interpretation that cost to the previous owner is applicable, this is a treaty interpretation issues, and there is no linkage to the Income Tax Act. And therefore, whether cost to the previous owner, grandfathering especially to the previous owner, is applicable or not is a huge question mark, especially when it concerns the pre-2017 Mauritius, Singapore, and Cyprus shareholders. Moving on. So we have a scenario where we saw in the earlier case that effectively it was share acquisition followed by a merger and issuance of equity shares. Now, let's say the selling company over here, it does not, for example, let's say the acquirer company wants to acquire the shares of the selling company or the business of the selling company, but it does not want an immediate cash outflow in a tight liquidity market. For the sellers, they understand that there could be no cash consideration, but they want a definite consideration. It could be deferred. So what could be a via media to address both these issues is the key commercial consideration. So here, the idea is that the selling company will merge into the acquirer company, and instead of issuing equity shares, it would issue non-convertible redeemable preference shares, NCRPS. What does this do? Effectively, NCRPS, if the value of selling company is say 100 crores, then NCRPS worth 100 crores will be issued, and therefore at the time of redemption, 100 crores of preference shares will be redeemed to the seller shareholders. Therefore, it's a definite consideration, but the market price of the business of selling company is capped. It's fixed upfront, and therefore, no matter what the timelines are, the seller shareholders will always receive 100 crores on redemption of preference shares. The key risk, however, from a regulatory perspective on the sellers is that what if there are no profits at the time of redemption of this RPS? Remember that under the Companies Act, redemption of preference shares can be made only out of two sources. One is profits of the company. Two is out of fresh issuance of share capital. So if there is no fresh issuance of share capital and if there are no profits, what is the recourse to the seller shareholders? That is a commercial risk that the seller is undertaking. To address this, there could be a put option where, for example, seller has a right to sell these NCRPS to the shareholders of the acquirer company and therefore recover their money through a secondary sale of preference shares to the shareholders of the acquirer company. Second, again, a classic interplay with FEMA. This structure is not viable if the seller shareholders are foreign shareholders. Why? Because NCRPS, while it's a share capital, it's considered as a debt instrument under FEMA, which requires an RBI approval. Now, in many cases where there is a potential outflow of foreign exchange in favor of a foreign jurisdiction, RBI is quite skeptical in granting its approval, and therefore this structure may not be viable for foreign shareholders. In terms of timeline, I'm assuming that it's not a listed company. The acquirer company is not a listed company, and therefore NCLT approval should be about 6 to 7 months. Insofar as tax considerations are concerned, merger is of course tax neutral. Capital gains will be there on redemption of NCRPS. If it is long term, then it will be taxed at 20%. And of course, whatever coupons are paid in the form of, let's say, if the redemption is after 12 months and 1 year of dividend is paid out to the seller shareholders to compensate for time value, then it will be taxed as dividend. Last point we saw that, again, the relevant method of accounting will be Ind AS 103 acquisition method. And therefore, if any intangibles are recorded, this will be tax deductible. Goodwill, of course, will not be tax deductible. Moving on. So we have a case where we have a holding company holding shares in a listed company, and the promoters are holding shares of the holding company. Now imagine a scenario where Holdco sells the shares of a listed company, the cash comes in the books of the holding company, and holding company then has to necessarily declare a dividend to the promoters in order for the cash to reach the promoters. So A, there is a leakage in the form of capital gains tax in the hands of the holding company. B, there is a leakage in the form of dividend tax in the hands of the promoters. Second, let's say if there are two families, which one family is controlling business one, second family is controlling business two. Today they are joined at the hip because they have a common holding company and they cannot have relevant control over the respective businesses. And therefore, the key over here is to eliminate this holding company. How do we do that? Effectively, holding company merges into the listed company, and listed company directly issues shares to the promoters. And therefore, the promoters will directly hold the shares of a listed company directly without there being a necessity to hold it through the holding company. Subsequently, if there is a family arrangement, then business one and business two could be demerged. There will be listed company one, listed company two. Both businesses are housed separately, controlled by two separate families. That is not possible in case of a common holding company. What are the regulatory considerations? One, majority approval of the public shareholders will be required. Why? Because any scheme of arrangement dealing with promoter and promoter group companies will require a majority of minority approval. The holding company today, however, from a regulatory perspective, holding company today carries a risk of being classified as an NBFC because it's just merely a financial holding company. That is mitigated. SEBI NCLT approval timelines we saw. Here, there is no listing involved, so 10 to 11 months, 8 to 11 months should be possible. There was a negative judgment in the case of Ajanta Pharma, where NCLT had respectfully but wrongfully held that merger of a holding company into the listed company will result in a tax benefit to the promoters. Why? Because they are effectively removing the extraction cost in the form of dividend tax. Now, there was no sale in the offing by the promoters, and therefore to presume that the promoters will get some benefit in an illusory scenario in future was wrongful. Many mergers after that have gone through NIIT Technologies, which is Coforge now, Godrej Industries, Apollo Tyres, etc. have gone through. The merger itself is tax neutral. But one important point over here is that the grandfathering of cost on 31st January will not be available. Why? Because the subject matter of grandfathering, which is the shares of holding company in the listed company, are getting extinguished and new shares are getting issued against the holding of the promoters in the holding company. So the subject matter, which is the linkage between holding company and listed company, that is getting extinguished. So therefore, the grandfathering of cost in this case will not be applicable. One major fiscal implication over here is that there will be a pro rata stamp duty on the fair market value of shares issued. What do I mean by this? Is, let's say the holding company holds about 50% in a listed company. Listed company's fair market value is, let's say, 10,000 crores. As a result of the merger, the first 50% is getting cancelled, against which new 50% are getting issued. So 5,000 crores worth of shares are getting issued fresh. In Maharashtra, stamp duty will be 0.7% of this, resulting in a straight stamp duty outflow of 35 crores. So stamp duty becomes a major fiscal consideration when one is considering a collapse of a holdco into a listed company. moving on to the second last case study. Here we have a case, and this was a live one in the case of Crompton Greaves, where Crompton Greaves wanted to divest one of its divisions to Advent International, which is a private equity play. So what it did effectively was that Crompton Greaves demerged its identified division into CGCEL, and CGCEL effectively became a mirror image entity having the same set of shareholding, which is 35% promoters and 65% public shareholders, in a mirror image sense. During one important point over here is that this is a typical mirror image demerger where there is no share swap required to be determined because the economic interests of promoters and public shareholders don't change. But one interesting part about it is that when the demerger was going on, they entered into a share sale transaction with Advent to sell the shares of a to-be listed company from Advance. So effectively, in order to optimize the timelines, a share purchase agreement was entered during the pendency of the scheme. And this makes it more interesting. From a regulatory perspective, like I said, there is no impact on the economic interests of the promoters and public, so no approval of the public shareholders is required. It's effectively like cutting an apple into two equal pieces, and A plus B is equal to the same economic value as they held earlier. Like I said, optimization of timelines, demerger and sale process were held to be in parallel. We spoke about the transitory control concept, that effectively, although at the first instance, it will be the same set of shareholders, promoters and public, but in step 2, immediately, it will be acquired by Advent, and therefore the assets and liabilities of Crompton Greaves consumer division would be recorded at fair value and therefore acquisition method of accounting. Remember that this is a listed entity which will become listed upon the demerger getting through, and therefore there will be a trigger of an open offer. Why? Because 35% of stake in the new entity was acquired by Advent International. What will be the pricing of the open offer? It will be basically the higher of the negotiated price or the FEMA price, whichever is higher. From a tax perspective, demerger will be tax neutral. Again, a listed company is split into two parts, and therefore grandfathering of fair market value, depending on the prorated net book value, should be available, which was prevailing as on 31st Jan. Let's say if the share price was 60 rupees, and if the pro rata cost split is say 60-40 or 50-50, then prorated cost split should be available. Stamp duty. Remember that this is an undertaking which is demerged into an unlisted company, and then the unlisted company is getting listed. And therefore, if the shares which are issued are not that of a listed entity, stamp duty should only be applicable on the net book value of the identified undertaking and not on the deal value, even if the deal value is discovered. So this is an important point where stamp duty is not levied on the deal value, but it is levied on the net book value, which can be substantially lower than the actual deal value. There are various precedents on this, Eureka Force being one of them. Mirror image demerger, Aarti Industries, Piramal Enterprises, various precedents on that. Coming on to the last case study for today is that we have an unlisted company which has a loss-making division. Listed company is interested in acquiring this loss-making division of the unlisted company. Now, unlisted company is not an industrial undertaking as defined. And therefore, if unlisted company is merging into the listed company, the losses will lapse. The definition of an industrial undertaking is there on the left, which is essentially manufacturing companies. Let's say this is a financial service company and it is making losses. So how do you protect the losses? Effectively, we convert a merger into a demerger. That is to say that the loss-making division will be demerged into the listed entity, and therefore the losses attributable to this loss-making division will be demerged into the listed entity. Why? Because the conditions which are applicable for carry forward of losses in case of a merger under section 72A are not applicable for carry forward of losses and unabsorbed depreciation in case of a demerger. But what are the limitations? The limitation is that while in case of a merger, a fresh lease of 8 years of losses should have been applicable. In case of a demerger, the listed company will only be able to enjoy the losses for the remainder number of years and not fresh for a period of 8 years. One key risk, GAR risk over here, is that if unlisted company does not have any other business, then the tax authorities will question this transaction to say that effectively you've converted a merger into a demerger, and therefore I'm rewriting this transaction as if it were a demerger, as if it were a merger, and therefore the losses should not be applicable. So therefore there should be some chunk of assets which remain back, some business which should remain back in the unlisted company to justify this as a demerger. If it's a loss making which is immediately shut down, then the question would be that whether this is whether the going concern assumption would be rebutted, and therefore whether it would be applicable or not. Assuming that if the transferee company was unlisted and if there was a shareholding change of more than 51%, then whether 72A would prevail or section 79, which provides that losses would lapse in case of change of shareholding, would prevail. Ideally, 72A should prevail because it overrides the entire provisions of the entire act. 79 only overrides the provisions of the chapter. Whether capital loss can be carried forward, the answer is no. This is only for carry forward of business losses and unabsorbed depreciation. MAT credit, whether that can be transferred, the answer could be yes. And last point, we looked at issuance of preference shares, whether that can be done to give an assured exit price, whether that would impact the tax neutrality of a demerger. The answer is no, because the provisions only provide for issuance of shares. It could be in the form of equity shares or preference shares. So with that, let me just sum it up and then probably I can take up the queries. So of course, there is an increased M&A activity through schemes of arrangement. When we look at a scheme of arrangement, there are various regulatory considerations, SEBI, FEMA, RBI, sectoral regulators, and of course, tax complexities around that. Especially given the uncertainty in timelines and complex tax and regulatory landscape, deal consummation itself could be jeopardized. We saw in a Sony case where final hearings were, the matter was heard in quite significant detail when certain financial creditors objected to the scheme going through. So, there could be a jeopardy in deal consummation, and we need to be cognizant of all these regulatory tax interplay along with the commercial objectives. So with that, let me just pause and happy to take any questions if there are any.
Okay, sir. Now we are conclude these sessions.
Sure, so I'll just stop the screen sharing and yeah.
Yes. I hope you all the participants enjoying the sessions. Thank you, Binoy Parikh sirs, for giving a wonderful sessions to all the participants. And I hope all the participants get the clarity from regarding the merger and acquisitions from Binoy Parikh sir. And also thank you to all the participants to joining us in this webinar. And I hope CP committees in future also create these seminars, and it's definitely helpful to all our future CAs as well as existing CAs. And we aware about the news, aware of the new era of the chartered accountant. Thank you so much to all of you guys.
Thank you.